Hi everybody. As you can see, I'm dressed warmly, and I'm actually recording this in the middle of the lockdown time. And I just thought I'd just share this worksheet with you. I've kept everything onto the same page, so you can see. I don't have to bounce backwards and forwards. Essentially, accounting is about getting transactions into the general ledger so that they can be summarized there, so that we can present information on the performance and the financial position of the company. So if you have a look, here are the transactions we're going to summarize. Here are the elements that you would find in financial information. One of the elements is asset. Another one is liability. Another one is income. Another one is expense. And another one is equity. If you have a look, before we go and look at these elements further, let's go and have a look at the accounting rule here. It says you cannot recognize an element until the recognition criteria are present. In other words, you can't record something as an asset, or as a liability, or as income, etc., unless the recognition criteria are present. And here are the recognition criteria. The definition of the element must be fulfilled. The cost or value must be reliably measurable, and the inflow or the outflow must be probable. So what I've done is I've gone and quickly put down the key points from each of the elements in the list below. So the definition of an asset: it's a resource, it's controlled, and future benefits are probable. So if I don't own something and I don't have any rights to it, it's not my asset, it's somebody else's, and I must be renting it from them. A liability, if I don't owe the money now, then it's not a liability. Income is a very useful definition. This, and thanks to the people who've put it together, it's taken years and years of refining to get it so nicely presented. It's an inflow of economic benefits, not money. Income is not an inflow of money, it's an inflow of economic benefits. You'll learn later that sometimes transactions are on credit, which means that the money's coming later, but it's still income for me now, and it'll get settled later. So I want to work out my performance now, and hopefully I've done my homework to make sure that where I'm extending credit to people, that I'm doing it in a responsible way, making sure that I have every possibility of the person who owes me the money paying it. So it's an inflow of economic benefits, and it results in an increase in assets and or decrease in liabilities. Okay, so money flows in, economics flow in, economic benefits flow in. There's a increase in assets and or a decrease in liabilities. So maybe I owed somebody money, and when I made the sale to them, I no longer owe them the money because the debt has been cancelled. So that's the definition of income. And you'll see in a few minutes that income increases equity, because I'll come back to that. So an expense is exactly the opposite. It's an outflow, not of money, of economic benefits. It results in a decrease in assets and or an increase in liabilities. And both income and expenses, when an equity participant or an owner puts money in, that's not income. That's a capital contribution. And in the same way, if an owner or an equity participant is repaid, that payment is not an expense. It's a return of capital or a payment out of capital to the owner. So there's some very nice definitions of income and expenses there. And then finally, equity is assets minus liabilities. Now think about that. What I own minus what I owe. What I own minus what I owe. That's what my equity is. It actually sounds like it's more than just a word. It's actually my wealth. If I want to know what my financial worth is, I should take what I own and subtract what I owe. Assets minus liabilities. So if you go back to the definition of income, it's an inflow of benefits and it results in an increase in assets. So what does an increase in assets do to my equity? Well, it's going to increase my assets, isn't it? So that's going to have a positive effect on equity. Just for the record, sometimes when we sell something, there's always a cost associated with what I sell. So I can't say that my income is my profit. I've also got to take the cost into account in working out the true effect on my equity. So now that we've got that right, just a final word. We've got some rules here for accounting in the general ledger. Now we've set our general ledger up as a spreadsheet today. And you can see I've got the headings for the elements. I'll highlight them. Assets, equity, and liabilities. Assets, equity, and liabilities. Now what I've done is I've actually presented the general ledger in the form of a spreadsheet. And what we're going to do in the next session is we are going to pop these 7 examples into the spreadsheet, and we're going to summarize these transactions so that I can work out the financial performance and the financial position. I'll see you back just now.